Section 1. There is a fundamental misconception that governs the public understanding of economics, the belief that the Federal Reserve holds the monopoly on the creation of the United States dollar. We are taught that money flows down from the central bank, expanding and contracting based on the whims of the FOMC. This is a comforting fiction. In reality, the vast majority of the liquidity fueling global commerce for the last 60 years was not printed by the US government. It was conjured into existence by private banks, offshore in a regulatory vacuum. We are looking at a shadow currency that exists everywhere and nowhere. Now let's open the ledger and audit the system that determined the cost. To understand the architecture of the modern financial world, we must travel back to the paranoid chill of the mid-1950s. The origins of the Eurodollar System, the offshore market for US dollars, lie not in a grand capitalist design but in a defensive maneuver by the Soviet Union. As the Cold War deepened, the Soviets found themselves in a bind. They earned dollars from selling crude oil and gold, but they were terrified of depositing those funds in New York banks, fearing the U.S. Treasury could freeze their assets at a moment's notice. The solution was an accounting loophole. The Soviets deposited their dollars in London-based banks, specifically the Moscow Narodny Bank, and later British merchant banks. These were U.S. dollars denominated in U.S. currency, but they sat on the balance sheets of banks in London, outside the legal jurisdiction of the Federal Reserve. Technically, the dollars never left the American banking system. The actual funds remained as correspondent balances in New York, but the ownership and the liability moved offshore. This was the spark. What followed was an explosion of regulatory arbitrage. In the post-war era, American domestic banks were stifled by Regulation Q, which capped the interest rates they could pay to depositors. London banks, however, operated without such constraints. They realized they could borrow these offshore dollars, now dubbed Eurodollars, and lend them out at higher rates to multinational corporations hungry for capital to rebuild Europe and expand into Asia. When we audit the mechanics of this period, we see a profound shift in the nature of money itself. Before the Eurodollar, money was largely viewed as a physical reserve or a direct central bank liability. Under this new regime, money transformed into a pure ledger entry. If a bank in London lends $1 million to a bank in Tokyo, and that bank lends it to a firm in Singapore, the volume of dollars available for transaction increases, yet the Federal Reserve has not printed a single bill. This is credit creation decoupled from sovereign reserves. By the 1960s and 70s, this offshore market had mutated from a Soviet stash into the primary engine of global trade finance. It allowed the world to bypass the capital controls of the Bretton Woods system. While economists like Milton Friedman were obsessively watching the domestic money supply, M1 and M2, the real action had migrated to the shadows. The Eurodollar market became a decentralized global banking network that operated on trust and interbank liabilities. It was a fractional reserve system without a central reserve manager. This distinction is critical for our autopsy. In the domestic system, if a bank gets into trouble, it calls the Fed. In the Eurodollar system, there is no lender of last resort. There is only the balance sheet of the counterparty. As long as banks trusted each other's solvency, the ledger expanded, creating a massive invisible ocean of liquidity that facilitated globalization. It was efficient, it was frictionless, and it was entirely opaque. The regulators in Washington assumed they were the captains of the ship, unaware that the hull was being expanded by phantom engineers below the waterline. The system worked perfectly, generating the illusion of infinite liquidity, right up until the moment the ledger required a mathematically impossible settlement. Section 2. To truly understand how the global economy functioned and subsequently failed, We must abandon the textbook definition of banking. The academic model suggests a bank takes in a deposit of $100, sets aside $10 in reserves, and lends out $90. This is the money multiplier taught in Econ 101, but when we audit the operations of the Eurodollar system, we find this model is obsolete. In the shadow banking world, money is not constrained by reserves held at the central bank. It is constrained only by balance sheet capacity. Balance sheet capacity is the raw horsepower of the shadow engine. It is a mathematical calculation of risk management. If a global bank perceives low volatility and high trust, its risk models, typically value at risk as VAR, give it the green light to expand its balance sheet. It can lend more, borrow more, and leverage more, effectively creating money out of thin air. Conversely, if volatility spikes, the math dictates an immediate contraction. In this system, money is not a static store of value, it is a dynamic measure of bank risk appetite. The heartbeat of this engine is the repurchase agreement, or repo. To the uninitiated, the repo market is dull plumbing. To the forensic accountant, it is the single most critical component of global finance. A repo transaction is effectively a short-term loan collateralized by securities. One bank lends cash to another, receiving a safe asset, usually a U.S. Treasury bond, as collateral, with an agreement to sell it back the next day at a slightly higher price. This turns distinct assets into liquid cash. It makes the bond market function like a checking account for the institutional world. However, the Eurodollar system introduced a dangerous accelerant to this process: rehypothecation. Rehypothecation is the alchemy of the shadow ledger. It allows a bank to take the collateral pledged to it by a borrower and pledge that same collateral to secure its own borrowing from a third party. When we trace the ownership chains in the pre-2008 era, we see a single U.S. Treasury bond backing 3, 4, or even 5 different chains of liabilities. This created a velocity of collateral that mimicked the velocity of money. The system looked incredibly liquid because the same assets were being used repeatedly to settle multiple debts simultaneously. It was a hall of mirrors where $1 of true collateral supported $10 of shadow obligations. This insatiable hunger for collateral explains the true nature of the 2008 crisis. Standard narratives blame subprime mortgages and predatory lending to homeowners. While true, that is merely the symptom. The systemic cause was the shadow engine's desperate need for pristine collateral. There simply weren't enough U.S. Treasury bonds in existence to support the massive demand for repo transactions required by global trade. So, Wall Street engineers synthesized them. They took toxic subprime loans, bundled them, and mathematically massaged them into mortgage-backed securities, MBS, stamped with an ADA rating. The financial system didn't just buy these MBS for the interest yield. They bought them to use as poker chips in the repo market. They needed safe assets to pledge as collateral so they could keep borrowing and lending in the Eurodollar ocean. Then came the cardiac arrest. It started on August 9, 2007. On this date, a full year before Lehman Brothers collapsed, BNP Paribas suspended redemptions on 3 funds because they could not value the assets inside them. This was the moment the balance sheet capacity evaporated. The logic of the shadow system is binary. Either an asset is safe collateral or it is worthless. There is no middle ground. When the market realized that the ADA-rated mortgage bonds were actually contaminated, they didn't just drop in price, they became non-repo-able. This triggered a run on repo. Unlike a Depression-era bank run where grandmother lines up to withdraw cash, a run in the shadow banking system happens silently on computer screens. Lenders simply refuse to roll over the overnight loans, or more insidiously, they increase the haircut. A haircut is the discount applied to collateral. Before the crisis, a bank could post $100 of mortgage-backed securities and borrow $98 of cash, a 2% haircut. As panic set in, lenders demanded higher margins. Suddenly, that $100 bond only secured $80, then $50, then zero. When we analyze the balance sheets from 2008, we see the catastrophic result of this math. Banks were not necessarily insolvent in the traditional sense. They were stripped of liquidity because their collateral was rejected. The velocity of collateral ground to a halt. The rehypothecation chain snapped. If a single bond was backing 4 different loans and that bond was rejected, 4 distinct pools of liquidity vanished instantly. The Federal Reserve, looking at its domestic dashboard, missed the diagnosis. They flooded the system with reserves, quantitative easing, thinking the banks needed cash. But the banks didn't just need cash, they needed trust and collateral. The Fed was trying to fix a broken transmission with more gas, unaware that the gears themselves, the Eurodollar trust network, had been stripped. The collapse of Lehman Brothers was the inevitable result of a system that had built a skyscraper of liabilities on a foundation of rehypothecated phantom assets. The shadow engine, which had powered globalization by circumventing sovereign controls, had finally encountered a variable its risk models couldn't calculate: the complete cessation of trust between banks. The ledger had expanded beyond the capacity of reality to back it, and the subsequent correction was not merely a recession, it was a systemic margin call on the global economy. Section 3. We are now living in the aftermath of the breakage. If the 2008 crisis was the cardiac arrest, the era that followed, the era of quantitative easing, is not a recovery, it is life support. A critical divergence has occurred in the ledger. On the surface, we see stock markets at all-time highs and central banks expanding their balance sheets by trillions. But when we look at the plumbing of the Eurodollar system, we see a chronic, suffocating contraction. The patient is bloated with medication, yet starving for oxygen. The central paradox of the post-2008 economy is the dollar shortage. How can there be a shortage of dollars when the Federal Reserve has printed trillions? The answer lies in the definition of money we established in Section 1. The Federal Reserve creates bank reserves, a distinct form of liability that sits inertly on the balance sheets of commercial banks. It does not create Eurodollars. It does not create balance sheet capacity. In fact, by purchasing trillions of dollars of U.S. treasuries through quantitative easing, the Fed stripped the market of the very thing it needed most: pristine collateral. Remember the engine from Section 2. The shadow banking system runs on collateral velocity. When the Fed buys a treasury bond from the market, it locks that bond away in its vault. That bond can no longer be rehypothecated. It can no longer support a chain of repo transactions. It can no longer act as the lubricant for global trade. The Fed replaced a useful, velocity-rich asset, the bond, with a static, velocity-poor asset, bank reserves. Consequently, the offshore banking network has become structurally risk-averse. New regulations, such as Basel III, forced banks to hoard high-quality assets to meet liquidity coverage ratios. The balance sheet capacity that once fueled global growth has been regulated out of existence. Banks are no longer willing to lend dollars to emerging markets or supply liquidity to repo markets at the slightest hint of volatility. The result is a silent crunch. Global trade has stagnated because the mechanism for financing it, the Eurodollar loan, is broken. We see this in the periodic spasms of the market. The repo spike of 2019, the dashboard flashes in March 2020. These are not random accidents. They are symptoms of a system that has lost its elasticity. The offshore world is structurally short of dollars, creating a massive synthetic short squeeze. Every time the global economy tries to accelerate, it hits the hard constraint of the Eurodollar system, causing the dollar to spike in value and crushing borrowers from Brazil to Indonesia who owe debts in a currency they cannot print and cannot borrow. The ledger reveals a grim verdict. The Federal Reserve is trapped. They are fighting a solvency issue in the private sector with liquidity tools for the public sector. They are trying to fill a bucket with a hole in the bottom, unaware that the bucket itself, the Eurodollar trust network, has disintegrated. To conclude our audit, we must accept the sobering reality about the nature of modern value. Money is not a token issued by the state. It is a measure of the system's capacity to trust. We built a global economy on the assumption of infinite, frictionless credit, a shadow ledger that promised to expand forever. But that ledger was essentially a promise, and in 2008, the promise was broken. What remains is a zombie system, dependent on central bank intervention to simulate the heartbeat of a market that no longer functions on its own. The cost of this intervention is the distortion of every price, every asset, and every risk in the global economy.